Hello, and welcome to 3C Money Matters, a podcast for clients, colleagues, and community. I'm Alyce Zollman from the 3C group of Baird, and joining me today, as always, my colleague, Dan Matthews. Dan, fresh off attending the World Cup in Seattle. Dan, how are you this morning?
I'm doing great. Had a great time out in Seattle watching Bosnia-Herzegovina and Qatar. So it was a great combination. It was awesome to be around all these different cultures and different people. Great World Cup vibe going on in Seattle, not just with those teams, but with all the different cultures that are out and watching the games.
Well, for those that are listening to us today, you cannot see that Dan is fully decked out in USA men's soccer garb, jersey, hat, a Bosnia-Herzegovina scarf. So apologies if you're not getting to see this visually. It's stunning. Well, Dan, so glad you had an awesome time. Joining us this morning as our guest is one of our favorite Baird colleagues, Ross Mayfield. Ross is an investment strategist with Baird Private Wealth Management. He attempts to help us and our clients separate news from noise, and you'll frequently find him appearing on national media and publications like CNBC and Bloomberg. Ross, how are you this morning?
I'm good. It's great to join you and Captain America on the show today. Excited. Yeah, I know we were talking a little bit before, but the World Cup has been so awesome to see fans from around the world come here and discover like ranch dressing and Buc-ee's and all the stuff that we bring to a world stage. So it's a blast, and I'm super jealous you got to go to a game in real life. That's awesome.
Well, and hopefully Dan got to see in person some of the hopefully tremendous economic impact that hosting the World Cup can provide. So look forward to hearing more about that. But Ross, again, we appreciate you joining us. This month is the 1-year anniversary of the first ever episode of 3C Money Matters. And Ross was our first ever guest. So we're thrilled to have you back, revisit some of last year's discussion. But Ross, I'll start, since we have had you on before. We thought we'd let you off the hook with our typical first question, which is, what is your favorite movie and why? Because last year, you gave us a real challenge in saying your two favorite movies were WALL-E, which has no dialogue, and Pulp Fiction, which doesn't have much dialogue that we can quote on this podcast. So.
Yeah, I really threw 104 down the middle for you guys on the first podcast. I mean, that's just bad participantship by me. Apologies.
No worries. Any updates for us on any other good movies or things that you think would be worthwhile to mention or have us quote?
Well, if I made it difficult the first time, I'll see if I can help this time, because we're taking my daughter to see Toy Story 5 this weekend. So I thought, all right, what if I gave you all 4 previous Toy Story movies? A lot of dialogue, some classic voice actors. I don't know if you guys are up in the cartoon world. Clearly, my having a 5-year-old shows through with suggesting 2 of 3 movies being cartoons, but I'll give you 4 to choose from if that helps a little bit.
That's pretty easy for me with having had kids, so I can come up with 1 or 2.
Actually, I think that leads us right into our first market-related question, doesn't it, Dan?
Sure. With the market going up like it is, would you say that it's going to infinity and beyond?
Well done. See, this is why you guys are the best in the business. Look, it's been a great bull market that we've been in. I do get the sense that there's an anxiety around how good it's been, which is just such a classic human thing. When the market's going down, we're worried, and when the market's going up, we're worried, right? We're always anxious about something. And the parallels to the .com bubble, I think, are loud and clear, even for investors who might not pay super close attention to the investing world day in and day out. But anyone who was around in the late 90s will remember the cultural moment of the .com boom followed by the bust. And because it's a bull market with a brand new kind of internet-based technology right at the center of it, and an AI, there's just been this extra anxiety. What I would say is I do think the market can and will continue to go up from here. The signs that we're at kind of a classic top are not really there. And just in terms of a bull market, right, which is just basically when the market goes up, I mean, this is only a couple of years old. Like, it feels like it's been going up and to the right for a long time, but 2022, the market was down 25%, bonds were down. It was a really bad year for the market, and it only bottomed in late 2022. So we're less than 4 years into a bull market, which, you know, if you look at the last 100 years of US history, would make this not even as long as the average bull market, and as far as returns, not even as strong as the average bull market. So it feels like a bubble to some, but in terms of just getting to the average bull market, we're not even there yet. So I think there's legs to go. I think the drivers you want to be the drivers of market strength are there in terms of earnings, in terms of people working. And we can get into all that if you want to, but just to put a bow on it, I would say, you know, I think we're pretty optimistic that things can continue higher for, you know, maybe several more years, not without the usual volatility, of course, but all the legs that a bull market stands on are still intact.
Ross, looking forward a bit, what are some key market and economic issues that are top of mind for you as you look out over the next 3, 6, 9 months and beyond?
Yeah, for sure. Well, I mean, the first thing is I would say that the difference between a bull market that has like some staying power and a bubble is, you know, a bubble is when prices get totally detached from reality, right? That's kind of the whole idea, whether it's stocks, whether it's real estate, whether it's, you know, some of the first bubbles, financial bubbles in modern history where there was a big tulip bubble, right? Like the actual flower. So the prices become detached from reality, and the prices have been strong, but the earnings that underpin the stocks we own have also been really, really strong. I mean, if you follow the stock market, this is not a house of cards in the sense that prices are going up, but the fundamentals of the companies aren't, you know, keeping pace, right? Your chip companies, your companies at the center of the AI build out, your consumer facing companies, your energy companies, like earnings in the first quarter of 2026 were really as strong as we've seen in the last 20 years outside of a recession recovery, right? Where your earnings look strong because last year they were so bad. So this has been a really robust environment. So that is something we need to see keep going. If earnings start to slow, but prices keep accelerating, that's when the yellow light starts to come on. So the key drivers there, I mean, the AI build out is a big one. There seems to be just an insatiable demand for that sort of stuff. But then the US is still at its core a consumer economy, right? It's people going to the World Cup. It's people spending on restaurants and tickets and travel. That is what we do, and that is what we do well, and that is what makes up most of the economy. So in the US, as long as people are working, people are typically spending. Now, it doesn't mean that they're not upset about prices or kind of grumbling about the inflation that we see in a lot of corners of our world, but people are working. Tax refunds were pretty strong across the board this year, and consumer spending has really held up. And then you add on a layer of a lot of people coming to the US to spend on ranch dressing or at our bars or whatever it might be. And you've got the kind of underpinnings for a decent economic expansion in place. The tariffs have been largely rolled back, so that headwind is gone. The war in Iran seems to be wrapping up. I'll knock on wood because things change pretty rapidly there, but we've come to this memorandum of understanding. Oil prices are back to where they were prior to the war, and gas prices usually follow, albeit with a lag. So that helps consumers across the board. So things aren't perfect, but I do think that a lot of the fundamental things are in place for the market to continue higher. Now, it always comes with the caveat of the average intra-year drawdown is 14% for the S&P 500. So even at its worst during the US-Iran conflict, the market was down maybe 9-10%. So the pullback didn't even reach the level of average despite all of the anxiety in the headlines and anxiety in consumer wallets. So, volatility is part of the game, but I do think that everything you'd want to see is largely in place for this to continue. And of course, we'll keep our eye on the things that might shift it from bull market to bubble down the road. I just don't think we're there yet.
As we look further into the latter part of this year, obviously we've got midterm elections coming up. That tends to be central in our clients' minds, certainly, and understandably so. Can you give us just some thoughts there, obviously without getting too much into politics, but any words of wisdom to pass along when it comes to midterm elections?
Yeah, for sure. It definitely weighs heavy, and politics have kind of, for better or worse, taken a more central role in markets in the last several years, both kind of monetary policy and the Federal Reserve, and I know we'll talk about interest rates maybe later, but also policy making at the federal level, right? Budget deficits, big tax bills, a lot of infrastructure spending. Post-COVID, we've had a bunch of big pieces of legislation that have impacted markets and what sectors have worked and not. So policy matters, but politics don't, right? The market has gone up under both Democratic and Republican administrations going back 100 years. It's gone up under unified and mixed governments. It has really been a bad investor policy to change anything based on who's in the White House. And the other thing about midterms is the way this pattern has gone, especially lately, is you have a new administration in the White House, and then in midterms, they lose ground, right? This happened with both Democrats and Republicans over the last decade or so. And so what the kind of betting markets and pollsters are showing is that the likelihood is we end up with a pretty mixed government on the other side of the midterms. And while that can be frustrating to, kind of a constituent who wants to see policy made and things being fixed, the market tends to like it because the market tends to like when politicians can't get overly involved in their day-to-day business. And as investors, we're invested in companies who are building things, innovating, and they typically don't want policy making to interfere with their kind of capitalist incentive. So if we have mixed government, again, as is expected at this point in time, now we've got several months, investors typically tend to cheer gridlock. Now, again, as a citizen, maybe that's not the best thing, but for investors, it has tended to be good over history. So we'll keep our eye on it. A lot could change. Obviously, if gas prices come down a lot, that could, put the wind in the sails of some and take it out of others. But as for right now, it's the two things: bad policy to think about politics and investing. And then two, we might actually be heading towards a kind of a market friendly backdrop if there's gridlock in Washington.
So I had one question actually to go away from the script here for a minute, but I did want to ask about, I got word from Buzz Lightyear that he was very curious what you thought about SpaceX.
That's perfect. Look, I can say, I'm 35. I've been, doing this for 11, 12 years. I've never seen the kind of inbound requests and general excitement for a new company coming public before. So there is clearly, maybe not quite a euphoria, but a real enthusiasm for these big private companies that have been kind of walled off for most investors for a while, for the theme of space and what that can mean, both, putting satellites up for internet, actually, launching maybe data centers. Like there's a whole kind of unexplored ground there. I will have been typically kind of the guy who throws a little bit of cold water on this. And I don't want to, I can't comment on SpaceX particularly like in the specifics because we're just getting their financials for the first time. They look to me like a big private company. They've been aggressively scaling and maybe not the most profitable yet, but that's pretty typical from a younger company. IPOs have a really checkered history in terms of performance down the road. And I've written about this a little bit. IPOs are kind of like the stock market on steroids in the sense that there are a handful of big winners and a lot of money losing companies. And particularly when companies come public, in the late 90s, there was this big boom of IPOs. Everyone who created a website or an internet company in their dorm room wanted to go public as quickly as possible because it was a gold rush. And there were a bunch of paper millionaires who were 22, 23 years old. And by 2002, most of those companies either didn't exist or they'd been bought for pennies on the dollar. So I think the stat is since 1975, about 60% of IPOs have returned 0% or less 3 years out. Now, there are big winners, right? There's a reason there's a lot of enthusiasm and excitement for a company like SpaceX, but I would urge people to kind of tread carefully when investing in more unproven companies that aren't profitable. And a history of IPOs suggests, it's a tricky or dicey proposition. So a lot to be excited about. The theme of space is exciting. But I would say tread carefully, especially if it's not money, you can't afford to lose, so to speak.
When we talked this time last year, another key issue central in our minds, and I think yours as well, was interest rates, the Federal Reserve, what may happen there in the near term. Here we are 1 year later, and that's still a pretty central issue in our minds. So could you let us know at this point, as you look forward, what you're looking for in terms of rate policy?
Yeah, for sure. I mean, you're right about the importance of interest rates, right? Like the best way to think about rates is it's the cost of money. And that is the central driver of everything, right? Businesses borrow, businesses as big as, SpaceX and Google and Facebook are tapping the bond market, to fund their expansion plans, all the way down to, credit card rates and mortgage rates for the average consumer. So rates really are everything. They're kind of one of the one or two fundamental building blocks of what we might expect from stocks, certainly what we can expect from, bonds. So it makes sense to pay so much attention to it, even if the kind of like minutia of Federal Reserve policy is kind of wonky and kind of boring. We have a new Fed chair, which is something worth kind of dissecting. He had his first meeting the other week, committed to the Fed's 2% inflation target, committed to trying to get to maximum employment, which is a Fed mandate. And basically, I think we can take out the idea that the Fed is going to cut rates a lot this year. When we came into the year, the market was expecting 2 or 3 rate cuts. Then oil prices went up with the war in Iran, and we basically had to pivot. Inflation has started coming back up, and the Fed has a hard time cutting rates, when inflation is on the rise. So what do we expect? Honestly, if I had to place a bet today, I would bet that we don't get any rate cuts or rate hikes by the end of the year. And we're kind of in a status quo environment for a while. So we could see mortgage rates kind of drift down a little bit further now that the fingers crossed, worst of the war in Iran is past. But I would expect kind of a status quo here. There's a lot of pressures that we expect to keep rates, higher for longer, at least compared to the 2010s. Part of the issue is we anchor to what's recent in our mind. And, the 2010s saw interest rates around the world as low as they've been basically in modern history or even ancient history. There's some, the first loans were made in the BC era. And there's evidence that the 2010s had the lowest interest rates around the world in 5,000 years. There were several countries that had negative interest rates, right? Basically, you had to pay to put your money in a bank, which is unheard of. So that era, I think, is over. I don't think we're either, also going back to the 70s and 80s when mortgage rates were 14, 15, 16%. But I do think it's going to be your mortgage rates in the 5, 6, 7% range, the federal funds rate, which is the kind of shorter term borrowing, 3 to 4%. And I think that's kind of the status quo we deal with because we've got all these inflationary pressures that are really hard to weed out of the system, whether it's gas prices, whether it's electricity, whether it's, all of the other issues that come from reorienting supply chains around the tariffs, or just a lack of workers, right? Labor shortages around the country. The workers who are here get to demand higher wages. It's good for spending. It's bad for inflation. So, a long way to say I don't expect a lot to change by the end of the year. Although if we're back here in a year, maybe we can talk about what actually happened.
Ross, final question. You host a wonderful, I think, weekly podcast or show with Baird market strategist Mike Antonelli, who we've also had on as a guest on our show, called All That Matters. And we encourage our listeners to tune into that any chance you get. It's incredibly insightful. But in your most recent episode, you and Mike discuss how people should best prepare for the next bear market. or market pullback. And of course, none of us know with any certainty when exactly that may happen. But difficult markets are an uncomfortable but inevitable part of the long-term investment and planning process. So could you give our listeners just a quick overview of what you and Mike cover during this episode and maybe some factors you're looking at that could potentially trigger a sell-off and how people should prepare?
Yeah, for sure. And I'll say, I mean, Mike and I doing an episode on bear markets is pretty out of character for us. We're typically, pretty optimistic. Our next episode, we look a lot more like Dan because it's a 250th celebration of America episode. So we're decked out. We're all optimists, all why investing in the US has been so successful and we think will continue to be. But the kind of core of the episode is and I wrote about it this way a couple weeks ago, is like the Aesop's fable, right? The ant and the grasshopper. When times are good, when it's summer, you want to be preparing for when times are not so good. It's easy to invest in a bull market. There's still anxieties, there's still decisions to be made, but a rising tide really does lift all boats, and markets have been going up and doing great for the last 3.5 years. And, I mentioned at the top, I'd place my money on that continuing. But as you mentioned, we know that volatility and bear markets and downturns are simply a part of the process, right? As long as humans have their hands at the wheel, or even as long as AI models that are trained on humans have their hands at the wheel, there's going to be more volatility in prices than in the fundamentals, right? We get too excited, then we get too negative. And that's the kind of relentless cycle of humans. So we've had a couple bear markets this decade, right? COVID-19 pandemic came out of nowhere, down 35% in a couple of weeks. 2022, a more kind of drawn out grind lower on the back of higher inflation and higher interest rates. And then 2025's tariff shock. The market was down about 20% in just a couple of days as well. So these things can happen even in good times. And it's time to prepare now. And so the kinds of things we think about are, one, asset allocation, right? In good times like this, especially this time around, your stocks maybe have gone up a lot more than your bonds or other parts of your portfolio. And so rebalancing back to your risk tolerance, making sure you're not too overexposed to riskier parts of your portfolio. Because then when the downturn inevitably comes, you want to have that asset allocation and that diversification working in your favor, right? And if you have let your stock position get too big, then you don't have the kind of ballast that bonds or other diversifiers, might act as they're supposed to do, right? Benefit you in that way. Revisiting your entire plan, right? Making sure your risk tolerance is right. Working on the really important kind of financial planning and estate planning things. This is the absolute time to do it. Because when the market turns, you want to have all your I's dotted and your T's crossed. As for what might cause it, I mean, it's really the cop-out answer is it's the things that cause the biggest downturns are usually the unknowns, right? Because the market is always, millions and millions of investors every day trading second by second, trying to price the world perfectly, never getting it right, but always trying to put in every piece of information out there, right? So as the Iran war is happening, it's digesting in real time the Iran war, but it means that the Iran war is probably not going to be the big shock that sends markets lower. COVID-19, kind of out of the blue, big shock to the market. The tariffs, we knew that there would be tariffs. The level of tariffs was a big shock to the market. So what could it be? The tongue-in-cheek answer is something that we don't know about. My kind of intuition is if the Fed feels the need to raise interest rates for whatever reason, that is typically a thing that the market has a hard time dealing with. If you look at the late 90s, the market was clearly a bubble, a euphoric bubble, but it didn't really pop until the Fed started raising interest rates and raised the cost of money. 2008, same thing, right? Any market or bubble that's built on the back of some leverage, higher rates are going to hurt a lot more. So the housing crash. This was the case in the 70s, 80s. Higher interest rates are typically a tough thing for markets to digest just because, again, it makes everything more expensive. Borrowing for consumers, borrowing for businesses. It makes bonds more attractive to stocks, so people tend to rotate out. There are other concerns we keep our eye on, but I'd probably stop short of saying I think it'll cause the next bear market. It's not going to be politics. It's not going to be the national debt. And it's not going to be de-dollarization. Those are the things that we get the most questions about, versus their relative impact on the market. So the reason we say to prepare aggressively now is because we don't know what it's going to be and we don't know when it's going to come. We just know that it's probably inevitable.
Something I talk a lot with clients about when it comes to difficult markets is it's not the punch you see coming that knocks you out. It's the one you don't. And certainly something our team wants to be helping our clients with is certainly markets and investing, but planning as well, planning for those opportunities to help give peace of mind that when tough markets occur, you're going to be okay long term. So with that, Ross, we are so appreciative of your time again this morning. It's always great to see you and talk with you. We hope you'll be willing to join us for another episode sometime soon. Dan, thank you as always for looking so wonderful in your World Cup garb and for the great Toy Story quotes. But to our listeners, thanks for joining us for 3C Money Matters, a podcast for clients, colleagues, and community. The goal of this podcast is to back up our team's mission to be a great teammate. So with that, as I think they say in Toy Story, you've got a friend in me. Thanks for joining, and we'll catch you next time.
This broadcast contains the current opinions of the host and are subject to change. The broadcast is provided for informational purposes only, is not a complete analysis of every material fact regarding any company, industry, or security, and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Robert W. Baird & Company Incorporated, member SIPC.